Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. By now, I think it's pretty obvious how much I love finance memes, whether it is my Barbie finance sweatshirt, my EBITDA hat, or my array of mugs. We've got the classic In the Money mug, our Freak in the Sheets Excel mug, and for those tough days in the market, our Live, Laugh, Limit Down mug that pairs very nicely with our aromatherapy line, Smells Like a Man in Finance candle. And I haven't forgotten about our oil and gas fans. I know you want this. I love Canadian oil and gas hat. Well, they can be yours. All this month, we are going to be doing a swag giveaway. It's really easy. All you have to do is subscribe and comment wherever you're listening or watching the podcast. And every week, we're going to pick a lucky winner and you're going to get your pick from the swag store. So subscribe and comment, and one of these things could be yours. Okay, let's get into our episode. This week, we've got Dan Niles on the show. He's super interesting. He's been a tech investor for the last 30 years. And he says right now there is scope for a 50% drop in stocks. And he's not a perma bear, so his call is super interesting. Let's find out why he's so nervous about stocks right now. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions.
Once in a while, I get comments from people who say, I love the show, but I don't know how to get started investing. Let's fix that right now. First things first, you need to set up a trading account. There are two tax-efficient options that you can set up through your financial institution. First is the TFSA. You can put away $7,000 every year. And if you've never had a TFSA, you now have $102,000 in contribution room as of 2025 if you were 18 or older in 2008. This is great if you want flexibility, and any gains in this account are not taxed. Second is your RRSP. This is a great vehicle for saving for retirement. You can contribute up to 18% of last year's income up to a maximum of $32,490, and that can be deducted from your income taxes. Okay, so now you've set up your accounts, you need a trading platform like BMO Investor Line. The dashboard's pretty intuitive. The News and Markets tab provides beginner-friendly market insights. If you're curious about a stock, look it up, and you'll have access to research that billion-dollar fund managers read. That's the thing they don't tell you about zero-commission brokerages. Zero commission, but limited available research. You'll be able to easily move your money from one account to another, consolidating all your investments in one place. And when you are ready to buy that stock, bond, ETF, or mutual fund, you can do that all under the Trade tab. It's just that simple. Find a stock you like and add to cart. And right now, if you sign up for BMO Investor Line, you can get up to $3,500 cash back. Visit bmo.com/investorline to get started. So open that account, make that first trade, and tell us when you do. You can hit us up anywhere on social media @InTheMoneyPod, and let's help you get a little more in the money.
Dan Niles, thank you so much for joining me.
My pleasure, Amber.
You have quite a career, primarily investing in the tech sector, but it spans, going back to the 1990s. And the thing about being a tech investor, it strikes me, is that you can't be a perma bear and be a tech investor, right? It's sort of an inherently optimistic area of the market. But right now, it seems like you're pretty bearish. What's going on?
Well, it just comes down to two things that drive stock prices, right? It's fundamentals and it's the multiple. And so if you look at the S&P 500 entering this year, the multiple was 25 times when inflation's typically between 2.5% to 3%, which is where it was. The valuation normally for the S&P is about 19 times trailing. And if you're in a more recessionary type of environment, it's 15 times. So the valuation was already high. And people coming into this year, I think, were focused on all the good things coming from President Trump being the new president, which is, deregulation, less taxes, et cetera, and potentially the benefits of tariffs. And they weren't focused on potentially the bad side of that, which is you could have increasing inflation, a slowdown in growth, et cetera. And so my view was that earnings estimates growth for over 10% for this year were also probably coming down. And so it made it pretty easy to come into the year with cash as my top pick, invested in money market funds that yield 4%. And so far, that still looks pretty good. But to your point, you always end up with rallies, even in the midst of big bear markets. And so you want to change your positions when you get to oversold levels. And then in this type of environment, look to sell rallies when they kind of get into the upper end of what is pretty normal. And so that's kind of how I'm viewing things going in through the rest of this year.
So I want to unpack that a little bit, because I think there's a belief out there that we just need to get rid of this tariff headwind and then we can go back to the party. And the stocks, tend to stage this incredible rally every time it seems like the tariff headwind is dissipating a lot. What's the wake-up call to that maybe conventional wisdom?
Well, I think since the global financial crisis, it's been a one-way trade, because when the global financial crisis happened, you had the Fed resort to unconventional policies, taking rates to 0%, and that kind of happened around the world to some degree, as well as doing things like expanding their balance sheet. So they flooded the world with money. That got supercharged when you hit COVID, when you had governments handing out checks to people every week that weren't working. And so it's really been the combination of free money from the Fed and from the governments around the world that have kept the market going, kept the multiples expanding, and has everybody thinking, every dip's a buying opportunity, et cetera. If you look at where we are today, central banks are a lot more constrained. The Fed still has inflation above their 2% target. It's been above that level since 2021. And at the same time, the reason we're here is the government's trying to rein in the deficits they're running, which is 7% of GDP. You kind of want to get it back to a more sustainable level of 3%. So when you have the two things that have really helped multiples expand during this time, the Fed and the government both pulling back, I think you're in a situation where the fundamentals are going to start to matter more, and all that free money is not going to keep earnings growing faster than normal. And I think that's the situation you're in today.
And so what would it take for you to come back to the market? What factors do you think need to be in place before you feel comfortable coming out of cash?
Well, don't forget, I publish frequently. And so we put a lot of cash to work when the market was getting absolutely crushed in April. Now, where we're sitting, we're doing the exact opposite. So to maybe frame this a little bit, if you go back in time and you look at bear markets, you always end up with these types of rallies. So if you go to the global financial crisis, you had 11 rallies in the S&P that averaged 10% each, on your way to losing 57% of your money. Now, remember, the average return for the S&P 500 is right around 10%. It's right around 9.5%, actually. And so that's pretty amazing when you're getting that. And you had two rallies within that of the S&P 500 that were 18 and 19% each. Now, you go to the tech bubble, similar situation where you had 7 rallies in the S&P 500 that averaged 14% each, on your way to losing 49% of your money. And 3 of those rallies in the S&P ranged between 18 to 21%. So the current one, including the move of 3% today, is up about 17% or so. And so you're kind of in that range. And so unless you feel like, well, estimates are going to go up, or the multiple should expand even further from 24 times, it's very hard to be bullish in this scenario, especially, and I'm sure we'll talk about this, when you know that demand has been dramatically pulled forward in the first quarter to get in front of tariffs and to get in front of export controls for technology. You're going to have to pay that back, just given the magnitude of the pull forward you've seen.
I just want to unpack something when you say you see big, almost the biggest percentage rallies in bear markets where you can be down as much as 50%. Is that something you think is on the table, a 50% drawdown?
Sure. Yeah, because here's the reason why. You got to remember the U.S. economy is the biggest in the world by far. If you look at U.S. GDP in the first quarter, imports were up 41%. Now, to put that in perspective, you got to go all the way back to the third quarter of 2020 during COVID, when imports were up 88%. But the reason they were up 88% is the prior two quarters, they were down 54% in Q2, and they were down 12% in Q1. The reason imports were up 41% is everybody knew tariffs was coming. People were worried about export controls on things like semiconductors. And so there was this incredible pull forward in demand in the first quarter. If you bought an iPhone, a PC, a car, you name it, in Q1, you're not going to buy it again in the third quarter and the fourth quarter. So you're going to pay that back in the holiday quarters. But what you saw was when companies reported Q1 results, and I actually thought they were going to be good if you go back and read what I was writing. And I thought there would be a rally because of them, because you've had this pull forward in demand. So estimates didn't really go down that much. And so everybody's going, oh my God, things are great. But you can't have a 41% increase in imports and not have to pay that back at some point. And that's probably in the back half of the year.
Okay, so that calls for a little bit, maybe a big give back. But you know, when you call for these kind of big drawdowns, I look at the indicators leading up to it. You know, you mentioned the financial crisis, you mentioned the dot-com, and there were just signs of, you know, that famous line, irrational exuberance all over the place. Do we really see that this time around? I mean, there's barely any IPOs. You know, there aren't the same sort of like meme trading that we saw during the pandemic. How do you think about that? The fact that it doesn't seem like there's irrational exuberance everywhere. In fact, people are pretty pessimistic.
Oh, there's plenty of irrational exuberance. That's why you have 0-day options to expiration. You've got these massive moves, you know, intraday that happen, 9.5% rallies in a day. You have every retail investor thinks every dip's a buying opportunity, and you can't go wrong buying AI-related stocks. And so maybe touching on the AI trade for a second in terms of irrational exuberance or media coverage that makes, you know, spins everything as positively as possible. It's been amusing to me to see how many people interpret all the results coming out of the big Magnificent Seven companies as, wow, the AI trade is fantastic, because they're not actually doing any of the math around that. And so just touching on that, because that's driven the market for the last couple of years. If you look at the Magnificent Seven and you look at the big AI spenders within that, Microsoft, Google, Amazon, Meta, and you look at what their CapEx was in Q1, their CapEx was actually down. That's the first time CapEx for that group of companies was down sequentially since Q1 of 2023. By the way, for all of last year, CapEx for those companies was up mid-teens every single quarter sequentially. And so that's kind of an example of people trying to spin things and saying, well, yeah, but if you look at it year over year, it looks great. But you're like, well, yes, but the problem is that you're not having the growth on a sequential basis that you thought. And if you're going to more of a flat environment, you're going to see a very big disconnect from what companies have modeled in for semiconductor growth versus what's actually going on at their bigger customers. So that's just one example of many, but it's probably the most relevant, because that's the other thing I was worried about coming into this year, was that people were overly exuberant. There would be an AI digestion phase for all of this CapEx, and you're seeing that. It's just, you know, people are trying to focus on year over years because nobody wants to focus on sequentials. And so there's this big mismatch between those two things, as an example.
So I find this interesting too, because, you know, I'm in the media, so I guess I'm going to spin this in a positive way. But, you know, the fact that they are pulling back on that spending relative to what it was, it's still on an absolute basis, a very high investment that is going into artificial intelligence and semiconductors. And the fact that they're not doing it all at all costs points to what I was talking about earlier, that there isn't this irrational exuberance around it, that these companies are remaining disciplined in wanting to see a return on their investment before they pour even more money into it.
Absolutely. And that the companies are acting irrationally. What I'm arguing is just like investors back in 2000 were going, oh my God, the internet can grow at these unbelievable rates. And I'll give you an example. So, I lived through the tech internet build out in the late 1990s. And you had Cisco at that time, which was the most valuable company in the world and was considered the NVIDIA of its day. It came out in 2000 and said, we think we can grow revenues at 40 to 60% in a sustainable manner because we think internet traffic is going to double every year. Now, internet traffic has actually almost doubled every year since 2000. It's gone up about, close to 90% per year. Cisco's revenues have gone up 4.5% a year compounded since 2000. And that stock has never seen those levels it saw in 2000. And so what you have right now is people saying, oh, well, the growth last year in AI CapEx was up, close to 60%. And if I look at things on a year over year basis, Microsoft's a good example of it. It looks like the spending is up a lot, but people aren't focused on the fact that Microsoft, which was an investor in OpenAI in 2019, before anybody even knew what OpenAI was, has talked about, but we want that growth to go to what our revenues are growing at, which is near the mid-teens level. And so what you're going to see is estimates across the board for semiconductors, as an example, having to come down a lot from where people have it. So the companies are acting rationally, much like they did at the peak in 2000 when they weren't getting the return on all that internet investment. The investors, though, were focused still on year over year numbers. And then they walked in and got hit for 78% on the NASDAQ over 2.5 years because they weren't kind of getting to the point where this isn't just a one-way trade up. And I know that your viewers today will go, oh, well, it's different this time and AI changes everything. But I would argue the internet kind of changed everything too. And so it's just something to remember. And I know we're going to get to viewer questions later, but when you have valuations sitting for some of these companies at stratospheric levels, you have to think through that. And I'll give you a recent example. If you look at some of the innovation funds, for example, the AARK Innovation Fund, right? It was the poster child for excess. That fund, because the valuations and expectations for future growth were so out of whack with reality, that's where it was in 2020 in terms of the level. The S&P's up, and NASDAQ are pretty much almost doubled from those levels. So if I remember correctly. So you've got to be very careful of extrapolating growth in the past into the future, especially when companies are changing relative to what the media is portraying or what investors want to believe when you actually look at the numbers. And that's why NVIDIA stock has done absolutely nothing since the middle of last year, which is when we started talking about this in print, where we thought there would be a slowdown in CapEx. And that was going to make it much more difficult in some of these names where you were thinking revenues are going to grow 10% per quarter for the next 4 quarters, which is what people have modeled in for NVIDIA. And you're looking at their biggest customers and you're going, well, yeah, but their spending is actually down sequentially. And where it gets confusing is when you have things like export controls going in. Every country, every company on the planet that's worried about not getting chips is going to overorder and stockpile as many chips as they can. And so that also has to get paid back at some point. And I think you're talking the back half of the year.
We're going to talk about this, as you mentioned, stock specifics and how it applies to NVIDIA. But I'm going to do the thing that you said everybody is doing and says this time is different. And one of the ways to look at that, well, because I really want you to convince me of this, is like even NVIDIA, which you're using, is poised to generate, like what is different about this time is that we're not talking about money losing startups, right? They are generating a tremendous amount of free cash flow. The balance sheets are very healthy. NVIDIA alone is poised to spit out $130 billion in free cash in the next couple of years. Alphabet, Microsoft, 60, 70 billion in free cash. These companies that are poised to ride the next wave are in better financial health than the companies back in the .com that were poised to ride the internet wave.
Yeah, but you have to also remember there's a whole group of AI-related companies like OpenAI that are losing billions. And the final thing is you have to look all the way out to consumers. Is there a killer app out there that consumers are using every day?
ChatGPT?
Well, is your mother using ChatGPT? How about your dad? How about all your neighbors?
But all the kids, everybody younger than me is.
Oh, well, yeah, but that's not the universe of people who have money to spend, right? Because until you end up with something that you can say, hey, book me a flight to New York City, get me a hotel, do all of these things, and it does it for you, and it does it what a good intern would do. You have to get a return on that spend. That's the issue. And if you think about it, and the reason I started to talk about an AI digestion phase in the middle of last year is if you go back to the middle of last year, when Amazon, Google, and Microsoft, the three big hyperscalers, so the guys that people go to run AI applications, et cetera, right, the public cloud vendors, all three of those companies reported the June quarter of 2024 and had their revenue estimates go down across Wall Street for September of 2024 for the next quarter. By the way, when all of those companies reported the December quarter of 2024, they all had their revenue estimates go down for the March quarter of 2025. So this has been going on for 9 months, which is why if you step back and you pull up a chart of NVIDIA stock, you'll go, wow, this thing has underperformed since the middle of last year. But that's going on underneath the surface. But you end up with these rallies in between. And by the way, NVIDIA stock went down 49% from peak to trough during this drawdown period. Now, obviously, it's bounced back some, and that's great. But the reason it's doing this underneath the surface is because the biggest customers have been having issues with the return on their spending since the middle of last year. So you can say, oh, everybody younger than me is using these AI things, but it's not translating into revenues for these guys that are spending a lot of money, which is why you're seeing them say, yeah, our spending is going to slow down in aggregate. Obviously, you have exceptions like Facebook, which has done the best job of using the CapEx to drive, hey, these are the videos that Amber would like to see, and, these are the ads she's willing to look at and might engage with. And so they're using AI to help do that. The problem on Facebook's part is they don't have the hyperscaler business model, right? So there's no other way for them to monetize this like Amazon has with web services or Google has with Google Cloud, Microsoft with Azure. And so you have to go through these companies one by one and see what's happening. You're absolutely right. The big hyperscalers have a lot of cash flow, et cetera, but you still haven't seen the killer app. I mean, Apple has pushed out the AI applications for Siri into next year. And so that's another example of it not getting used as much as the investments going in. Don't get me wrong. I'm bullish on AI. What I'm saying is just like you could have been bullish on the internet back in 2000 and suffered a 78% drawdown, you have to be very careful when perception gets out of whack with reality. And if, it's funny when I tell people, yeah, these companies, the biggest companies have been missing numbers since the middle of last year. They're like, that can't be true. And they go back and look and they go, well, yeah, actually it is. And so that's what you need to stay focused on because stocks only work off of two things, right? Multiples and earnings. And right now, you got pressure on both.
You're so right. We should talk about this through stock specifics. So let's dip into the mailbag and do just that. Our first question, I feel like, is the poster child of everything we've talked about. It's on Palantir. The question is coming from Jacqueline in Vernon, BC. I've been surprised by the growth of Palantir, not able to wrap my head around the significantly higher valuations. Your thoughts on this ticker and how you see it in the future? Palantir, it's such a retail favored name, AI player, big contracts with the government, specifically on defense. How do you think about a name like Palantir?
Well, the answer was in the question, which is you can't wrap your head around the valuation. And so why are you involved? That's
because it goes up. It goes up 300% in a year.
Sure. A lot of internet stocks were up a lot in the late 90s. I mean, I brought up the AARK Innovation Fund. Did you want to really own it after it was up 150% in, I think, 2021? How was it done? Well, you got the same amount of money you had back in the peak in 2020. That's what happens when you ignore valuations. You get absolutely decimated if there's a problem. And so you have to, investing for the long term, not the short term, is about risk versus reward. And if you can't wrap your head around the valuation because it trades at 70 times revenues for 30% revenue growth, then yeah, you can trade it. I trade things all the time, but I know I'm trading them because I'm looking for a bounce, like in April. So if you can't wrap your head around the valuation, there's a lot of great companies that have reasonable valuations where you know they're going to do fine and be able to grow from their levels. Palantir is just one of those that, yeah, there's nothing that says it can't go up another 300%, get to an even more insane valuation. But, you know, Tesla's a good example of this. If you look at Tesla's stock over, I think 3 or 4 years, the stock is down while the market is up because the estimates have been coming down. Now, you have to look back over a longer period of time because obviously the stock is ridiculously volatile near term, but eventually you get to a valuation level where it matters. And so to me, it's all about risk versus reward. And if you think the market's going to be up, 20% from here, will Palantir be up, 40 or 60 or 100%? Sure, that's very possible. But to me, that's more gambling than it is. And let's face it, investing is gambling with better odds. That's really what it is, because you have no idea what the future is going to hold. But in Palantir's case, the odds are really stacked against you with the valuation that's that high.
Let's bring in another question on Shopify. It's a lower valuation stock, but one that I do see a lot of analysts complain about the valuation. This question coming from Clay on X. What is Dan's view on Shopify? I've owned it for 7 years now. What do you think?
Well, for me, you have another company that's kind of in the same space that is at a much better valuation. That's just a market share taker because of their advantage in their logistics network. And that company is called Amazon. And you can buy it at half the valuation that you can buy Shopify for. So for me, it's always, well, if you've got other options that let you play the same theme, and in this case, it's called e-commerce, then where do you get a better risk-adjusted return? And Amazon has shown that during recessions, they gain market share because they've got all the sellers on that platform. And so if you're shopping for a lower priced toy, because let's step back for a second. Are prices on anything coming out of China going to be bigger at the, during the holiday season than they are today because of tariffs? The answer is 100% yes. Now we can argue what that increase in price is going to be, but it's definitely going to be higher than where it is today. So I think that's just something to think about as you're, figuring out between Amazon versus Shopify, what you want to own or any other name in e-commerce. I'm a big believer in valuations because I've been doing this job. I've been on Wall Street since 1990. And so you see, as you said earlier on our podcast, irrational exuberance. And then when that gets broken, a lot of people get hurt. And then, recently, let's bring up NVIDIA, right? It went down 49% peak to trough. That's a pretty good drawdown. It's obviously bounced since then. We'll see where things go in the future, but that gives you an idea of what can happen when, expectations and reality get out of whack.
Let's stay with this study of Amazon versus Shopify, because you bring up some interesting points about valuation. Shopify is a much earlier stage company, and it has potentially a very large addressable market. That's what they say, right? If you think of Shopify as like a white labeling of Amazon, you give the companies the power to have an online retail experience the way Amazon does, but the company kind of owns that experience. They're much earlier in that phase than Amazon is right now. And back in the day, I mean, what was the joke? Amazon is like the world's largest nonprofit because they just lost money and invested. Shopify is already showing profitability, and it has shown tremendous growth over its period. So I'm curious how you think about that trade-off between it's earlier in the growth, and what should a valuation be for an earlier stage tech company? Maybe you can explain how you looked at Amazon back in the day.
Well, actually, let's look at Amazon. So if I were to tell you, hey, revenues are going to double over 2 years, you go, wow, that's going to be great. The stock's going to do well. And that's exactly what happened from 2000 to, I think, 2002. And the stock went down 95%. 95% it went down. Revenues did double. That's the answer to your question. So the thing to think about is this. If you believe that the economy and estimates are fine between now and the holiday quarter, which I would argue is going to be incredibly important, given that, even today you heard news stories about Apple planning on raising prices on their iPhones. If you think it's going to be fine, then Shopify will probably outperform Amazon. If you think that there's probably estimate cuts that need to happen, then Shopify is going to have a very big problem for its stock price relative to Amazon. So some of this is working, and my belief is the following: markets tend to coalesce around, dominant players. And you could argue in that whole e-commerce space, it's right now a battle between, Amazon and Walmart. And then the smaller players tend to get squeezed a lot more. And Amazon's really big advantage, quite honestly, is their logistics network. It's their transportation network. They can get things to you in a couple of hours at a very low cost. And so, I have nothing against Shopify. I've owned that stock in the past. But in where I think we are going for the next, let's say, 9 months, I'm trying to find more defensive type tech names that you could potentially get involved with if you're going to do that. For me, right here with the rally we're seeing today, I'm looking at, well, what can I sell? What can I short? Given I figured tariffs will go down today, I figured there would be a rally. And now I want to take advantage of that to reposition the things that I'm involved with. And so that's how I'm thinking about this. But if you think things are going to be wonderful, then yeah, Shopify will do great. And that's how it tends to work, right? The smaller companies tend to do better in bull markets because of what you just said, right? They have a lot more runway to growth, et cetera. But if you're ending up in periods of slower economic growth, the bigger companies with the better balance sheets, et cetera, who have shown they can take market share historically, those will tend to do better. And so all my answers are kind of in that vein.
Well, I like it. At least you're consistent. No contradictions there. Do you care about stuff like inclusions, like, Shopify getting included in the NASDAQ 100, maybe getting included in the S&P 500 down the road? Does that stuff matter to you?
No, because a lot of times it's a contraindicator. So I don't look at that at all. I mean, for me, it's, that creates some excitement. Well, that helps stocks in the short term. Absolutely. But, that doesn't matter.
Let's talk about Reddit. What are your thoughts on Reddit? Management seems to be crushing it on all metrics, but there's volatility due to changes in Google's search algorithm. The stock isn't cheap, but has had tremendous growth. Is it a buy, sell, or hold? This one coming from Goran in Toronto. What do you think?
The answer was in the question. When you're having an issue with a company like Google is changing your fundamentals around, I don't know why you want to take that risk within it. For me, over the last 2 years, not this year, I'd been a big believer in Meta because it had a really low valuation 2 years ago coming into the year when you remember they changed their name to Meta and they were going to spend $1 bazillion on the metaverse. And they didn't. The stock got crushed in 2021. I think it was down over 60% for the year, down 75% or something, peak to trough, and it did very well. But they have their own fate in their hands. And they're doing a great job with AI to drive their own business. The valuation is very reasonable. With Reddit, you have to worry about what Google's going to do. I don't want to be in something where their fate is in the hands of another company.
Okay, and we're going to talk about that stock when we come back from break. But first, take a listen to this conversation I had with Jamie Coulter. He's the CEO of Raymond James Canada, one of our sponsors, and he talked about how the company is helping clients navigate volatility and change. You're the CEO of a company at a time of incredible tumult, and I'd just love to get your perspective as a C-suite executive on the current climate. Do you see a recession coming? How much instability is there?
Well, again, I think your crystal ball is about as good as mine. And I do like to think, again, in a mix of headwinds and tailwinds. And you referenced earlier on different crises that we've seen along the way. So the internet bubble, the global financial crisis, COVID, and now this. During COVID, for example, we took advantage of that opportunity to move basically everything to e-signature. And that would have taken probably 5 years absent a global pandemic. So we're trying to do the same in this environment now. For example, we've got 25 different projects that are AI related, either live, pilot, or in the pipeline right now.
That's a good perspective, bringing up COVID, because as I understand it, you became the CEO of Raymond James Canada during COVID. And now here we are less than 5 years later, and we're dealing with another so-called once in a generation crisis. So it does kind of behoove you. You got to see the opportunities out of it because you did see opportunities come out of COVID.
I think it's really the only way to operate. It's hard to be an optimist sometimes. If Rudyard Kipling, if you can keep your head around you when all are losing theirs. But once you accept that, again, there is that opportunity that sits out there. And so I'm fortunate to be surrounded by a great senior leadership team who share the same thinking. And so we're sort of marching arm in arm forward, really thinking long-term, what can we do to invest in our platform, knowing that there's always going to be a crisis. And there could always be a reason to say, no, we should defer this. Let's just wait till things settle down. After 25, 30 years in this industry, that's not happening. There's always something. So if you, again, step back, think long-term, know that you've thought through things. And so, again, feeling well supported by a well-capitalized parent company based in the US, I've got pretty good confidence that we can and ought to make these investments today.
Okay, so we're back. Our next question here is about Google, Alphabet. So Dan, what is your take on Google? The analyst community is very divided on this name. This one coming from Raptors fan on X. It's a low valuation tech stock. Is it tempting to you, Dan?
I never want to be in market share losers. And I've been saying this since really the AI trade got going, where if you want to own AI related stocks, then you're asking a lot in owning Google, because either you believe the hundreds of billions of dollars spent over the last 2 years, and you said this earlier, Amber, right? You're trying to defend, everybody should be bullish on AI because all the younger kids are using all this AI stuff. Well, that means they're not using Google. You can't have it both ways. So either you believe that Perplexity, OpenAI, Anthropic, XAI, you pick your favorite. I use XAI or Grok every, day, multiple times a day, is taking some market share away from Google, or you don't. And for me, I don't want to be in a company where you have that going on, number one, because they're going to have to kill the golden goose, which is search, to try to stem this. And they haven't wanted to do that early on. That's an issue. Number two, I sincerely doubt they'll be allowed to keep their default search engine status on the iPhone going forward, given the legal issues going on. And so that, again, is an issue around market share. The valuation, don't get me wrong, is very tempting. And it's not to say the stock won't go up and down depending on, what they report for the quarters, but let's look at the big picture. In Q1 of 2023, their paid click growth, which is, search, was up 8% in the first quarter of 2023. Remember, ChatGPT was introduced in late 2022. A year from then, you go to the March quarter of 2024, that number dropped from plus 8% a year ago to plus 5. If you look at the March quarter of this year, that went to plus 2. If you look at what Eddie Q of Apple said, he said for Apple, their search was down for the first time in the month of April. So you're clearly seeing habits and what people are doing shifting. And ultimately, that is a big problem for Google on top of, the legal things going on. I really would like to get involved with Google because if you really think about AI, they were the ones that built the transformer technology initially that OpenAI used to get ChatGPT going. Google just sort of sat on it. They didn't do anything with it because I think in the back of their mind, they knew this was going to be a problem for their search business, which is the golden goose that funds everything else that they want to do. So Google's the most intriguing because you go, well, breaking the company apart might actually create value if that ends up happening. But for right now, there's a reason I looked at it earlier. I don't know where it is right now, but the stock was underperforming even on a big up day like today, when you would think, there should be a relief rally, should be doing better than the Magnificent Seven peers. And funnily enough, it really wasn't, at least when I looked at it, which kind of surprised me. So valuations sometimes are getting cheap for a reason, and I try to stay away from companies that are losing market share, especially when you've got a company like Google that has 90% search share. Like, there's only one direction for it. And I've said this, multiple times over the last couple of years, that AI is going to change the way we all function and do things. And that's going to mean we go less to the Google search bar.
I agree with you. And I feel like we're in the early innings because, to your point, like, are my parents using it? No, I still go to parties where people say, what is ChatGPT? But then, as I said, like myself, I find I'm using it every day, multiple times a day. And the young kids today, Dan, they're using it. And they're our future.
Just like with the internet back in 2000.
Exactly. Okay, so this is kind of related. We got a question from Ravi on X, his views on robotaxis and the future ecosystem. How do you see it playing out? And I say it's related because tucked in Google, of course, is Waymo.
Yeah, and to me, Waymo is very interesting. But, that's not what's going to drive that stock in the near term. It comes down to search. So, right now, you could argue there's really no good pure play on it. I mean, Tesla obviously has amazing technology. I love my Tesla. I can't wait to get, that upgraded to full self-driving where I don't have to have my hand on the steering wheel to see where government regulations obviously come out for all of this. I love having my car drive me to where I need to go with, my hand touching the wheel. So I think robotaxis is very, very interesting. The problem to me is there's not, in my mind, a good way to get at it where you're not having other stuff. Because don't forget, in Tesla's case, forget about all the stuff going on this year. Let's go to last year before politics had anything to do with Tesla. Obviously, you look at the revenues or the deliveries for Tesla, they were down last year for EVs. the entire EV industry was up 25%. The Chinese were taking tremendous amounts of market share. So you may want to invest in this, but it's such a small percentage of a lot of these companies' value right now that it makes it very difficult if you have something else going on like Google with search or Tesla, where, that's a great play on it, but you've got to deal with EV deliveries, for example. So I think that's what you have to work your way through. So there's no real good way for me to get at that right now.
Let's close out the mailbag. We got a question in on Apple. There's a lot of obvious headwinds on Apple, whether it's tariffs, whether it's AI. But, the stock has pulled back, and I wonder if you think that it adequately reflects it.
The company has done 5% cumulative revenue growth over the last 3 years. The average for the Magnificent Seven is 90%. Even if you take NVIDIA out, it's 50%. The only reason this stock has hung in is the multiple keeps expanding because people always think there's an upgrade cycle at some point. And they want to desperately believe that they're going to figure out this AI stuff, even though they're spending less than 3% of their revenues on CapEx. By the way, Microsoft and Meta are spending over 30%. And so there's a reason that the Warren Buffett has been selling the stock. So, yeah, I look at the valuation and I look at the fact that that iPhone sales were down last year when the industry was up 6-7%. And the Chinese took a tremendous amount of market share in China. And I look at this company and I go, that demand has been pulled forward. Because I know so many people that have either asked me or gone out and bought an iPhone because they were worried about prices going up because of where they're manufactured. And so the holiday quarters are going to be a big problem for them, and they don't have the AI technology. So I don't see any reason. And if you look at the smartphone industry, right, you have companies that have done well, and they miss a product cycle, and then they have a huge issue. And to miss the AI cycle, I think is kind of a big deal.
Yeah, I don't think that's controversial to say. And I keep saying I'm waiting for Siri to get a brain because, I'm right there. I'm ready to put Siri to work. I just need him to get it together. Okay, so that's a no on Apple. Let's find out where some of your conviction lies and get into pro picks. ProPicks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information.
Yeah, I think this year it's not about picking individual stocks because if I'm the macro and what's going on, as I said earlier, there's only two things that drive stock prices. There's valuation, which I gave you what the history was. At 2.5% to 3% inflation, the S&P should be trading at 19 times. It's at 24. The other one is earnings. People have earnings going up double digits this year. And as we talked about earlier, the entire U.S. economy had a 41% growth in imports in the first quarter. 41. So for me, this is about you're managing how much money you have in the market. When it rips, you think about selling it down. When it collapses and it looks like there's no hope, then you can buy it for a short-term bounce that should average 10 to 14% on average. But as I said earlier, I think, you've had rallies of 18 to 21%. You had that happen. There were 3 rallies of 18 to 21% during the tech bubble while you lost 49% of your money. So they can extend even further, which this one looks like it's going to. And I think it's more about managing that. From a bigger picture standpoint, like if you're trying to get involved with things, I think the last 2 years, it's been all about investing in AI infrastructure. I think this year, next year, it's going to be more about, we have all this AI data being created, but how do we move it around? How do we get access to it if we're a corporation? And so I think the networking space, Cisco is one of those names that I think should benefit from spending switching from just purely on a infrastructure to upgrading the networks, moving that data around. And so that's one of the ones that I would look at and say, you know what, I think hopefully over the next couple of years that outperforms even in a tougher tape.
So definitely parking it in cash for now. Like, I'm curious, how much of your portfolio is cash?
There's a reason that I came into this year having cash as my top pick invested in money market funds. So I'll just leave it at that, because it moves around quite a bit depending on if I'm in a period like when stocks have been absolutely decimated and I think something will change. Like in early April, we'll have a lot less cash. If we're in a period like now when the market's up 17%, the S&P from its closing lows on April 8th, then I'm going to have a lot more cash. And so that's how we tend to move it. That's how I tend to move it around.
And you mentioned Cisco as well as sort of a second area to kind of hide out. It looks like it wants to retest some of those highs at around north of $60, let's call it. When you say it could get caught up in some sort of infrastructure rally, what kind of upside do you see from here?
I don't think about it that way, because, if for some reason people then go, oh my God, this is an AI play, who knows where the multiple goes to, right? Because right now it trades at a high teens multiple. As we said earlier, the S&P trades at 24 times or so. You don't know. I try to pick fundamentally good companies where I think the estimates have a chance of going higher. It's clearly not a name that people look at and go, oh my God, this is an AI play, right? It's nowhere near that conversation. I mean, the stock's not even back to where it was in 2000. So the good news is that it's sort of forgotten. People don't care. But the last few quarters have been strong. They've got, they're going to report again this week. We'll see how that goes. I think it should be good. And it's a process for companies to re-rate. And I think Cisco is one of those companies that could re-rate and get at least a market multiple in the future if people go, yeah, you know what, networking, all of this data, that's important. And we've underinvested for a couple of years because we've been spending it all on AI. And now we've got more money to invest on upgrading our infrastructure to move this data around. So I don't ever put price targets or, where I think the valuations can go on companies. I just try to say, well, if I think the estimates are going up, which I think they could in Cisco's case, and unlike most of the tech companies, I think the multiple is actually low and could expand, then I think it's a good stock to be involved with. And, don't forget, I can short things to try to hedge risks. And so for me, Cisco is one of the most intriguing tech stocks out there. Which is why it was a top pick coming into this year, along with cash as my lead.
If you had to pick a Mag 7 stock that you, maybe let's call it, hate the least, is there one that stands out?
Well, I mean, if you want to look at it fundamentally, you can say, well, look at Microsoft. They had numbers go down after they reported the June quarter of last year. They had numbers go down after they reported the September quarter of last year. They had numbers go down after they reported the December quarter of last year. This quarter, they actually had numbers go up, and they had acceleration in Azure, which went from 31% year over year growth to 33%. Google Cloud and AWS both had growth decelerate by a couple of percentage points each in their businesses. So this is clearly one where on the margin, things are sounding better after sounding bad for the last 9 months. And their spending, which I really like, which had skyrocketed, they're cutting back on. Their spending was down sequentially in their March quarter. They've talked about their spending now going to track revenue growth, which is growing in the mid-teens. So if you look at it, that's part of the reason why this was the worst performing Magnificent Seven stock last year. And it's the best performing Magnificent stock this year. Is I think that change in how much money they're spending because they haven't seen the return they thought. And the business is turning underneath that. And they gave good guidance when they talked about June after having a good March quarter. So it's the one that I look at and I go, from a longer term perspective, it's the most interesting. NVIDIA, if you want to try to trade it, it could be interesting because I think, you have this big $5.5 billion write down. It's going to make it look like margins go up. Everybody's buying every chip they can get their hands on because they're worried about export controls, obviously. And so things may look okay for a short period of time. And then I think back half of the year, you're going to have another set of problems. But, that's more of a trading scenario. So unless you're willing to think about it in that manner, I wouldn't touch it. But because you've got revenues modeled in at up 10% sequentially for the next 4 quarters, and I don't think there's any chance they get close to that in the back half of this year. But that the valuation looks interesting, and I think people want to believe that AI is great. But again, what was interesting today in looking at the stock was it was actually underperforming relative to its peers, which I found very interesting. So I don't know if investors are actually starting to think forward and go, Microsoft cutting back is not good. And yeah, demand's been pulled forward or what. But, that's one of those that's probably more in the tradable category, but I'm not sure I would own it the day they report their results. So okay. We'll see.
We'll call that a bonus pick, like a little bit more of a short-term idea. Dan, I really enjoyed our conversation. I'm definitely feeling less Pollyanna than I was at the beginning of the conversation, but I think people need a dose of that too. So thanks so much for joining me.
Oh, my pleasure, Amber.
That's Dan Niles joining me. Make sure you tune in to our next episode. We've got Brent Joyce on the show. He is the Chief Investment Strategist at BMO Private Investment Council, and he's really good at taking on those big picture questions. So if you've got any macro questions, you can send us an email, questions@inthemoneypod.com, and we'll catch you on the next episode.